Hey, hi everyone. Welcome to another video. Today we are going to discuss about leverage buyout and discuss about a company called KKR, how it used to buy companies using leverage buyout, and how this strategy has been used successfully, and also what are the failures faced by the companies when they use this leveraged buyout strategy. So, what is a leveraged buyout? Leveraged buyout is a financial transaction in which a company, often it's a private equity firm, they acquire another company and they use a significant amount of borrowed money, debt to fund the purchase. So, they basically take debt and then acquire another company. Uh, okay, and this is typically done by a private equity firm. So the key features of a leveraged buyout are typically 70 to 90% of the purchase price is funded through debt, with the remainder from the acquirer's equity. Okay, and the assets and cash flows of the target company are used as collateral and to repay the debt. So they're taking 70 to 90% of the debt, and the assets of the companies and the cash flows of the companies are used to repay the debt and also used as a collateral for the debt. This often involves leverage buyout. All often involves cost cutting, asset sales, and operational restructuring to improve profitability and generate returns. How KKR, which stands for Kohlberg Kravis Roberts and Company, uses leverage buyout strategy. It is founded in 1976. KKR founders are Jeremy Kohlberg, Henry Kravis, and George Roberts. Headquartered is in New York, USA, and they popularized this leverage buyouts in the 1980s. Okay, so famous deal which KKR has done using leverage buyout is RJR Nabisco in 1989. Deal size was around 31.1 billion dollars, then the largest leveraged buyout in entire history. Target is RJR Nabisco. It's a conglomerate of food and tobacco. So they acquired that company using leveraged buyout. Outcome is it became a legendary deal basically, and it was even uh, written in the book called Barbarians at the Gate. And though the deal has closed, massive debt burden has strained RJR's operations, and eventually KKR's returns were modest compared to expectations. Okay, but there are some successful LBOs and leverage buyouts, and the examples are here. HCA Healthcare, which the acquirers are here KKR, Bain, and Merrill Lynch in the year 2006. And outcome is they went public in 2011, and it became a highly profitable exit. So yeah, and PetSmart, the acquirer was BC Partners, and it was in the year of 2015. They spun off Chewy.com for massive returns. Then Hilton Hotels is a successful LBO done by Blackstone in 2007. IPO in 2013 was done, turned 5 billion profit, textbook turnaround. Dollar General, again by KKR, who is the acquirer in 2007. Re-IPO was done in 2009, and they tripled their money basically, whatever they have invested. Haynes is again acquirer is 3G Capital plus Berkshire Hathaway in 2013. It merged with Kraft, and synergies were achieved. However, later faced brand valuation issues. There are also famous or failed or problematic LBOs. Examples are TXU Energy or Energy Future Holdings. The acquirers were KKR, TPG, and Goldman Sachs in 2007. Largest LBO in US history, around $45 billion, filed for bankruptcy in 2014 due to energy price collapse. Outcome. And Toys R Us, the acquirer was Bain, KKR, and Vornado in the year 2005. Heavy debt led to bankruptcy in 2007. Toys R Us is bankrupt in 2007. It couldn't compete with Amazon. Okay, Caesars Entertainment, Apollo, and TBG are the acquirers. And in 2008, year it was acquired. Bankruptcy was filed in 2015. High debt and economic crisis to blame. Linens and Things, Apollo Global was the acquirer in 2005, liquidated in 2008 due to recession and debt load. So why we need to use leverage buyouts? It gives high returns on equity. You see, right? The returns were like 3x, three times, and sometimes you also see the returns in many cases 5 billion profits. So such is the massive returns you get in LBO. So that's the first important thing, that you get high return on equity. Leverage amplifies equity returns if the business performs well. You'll get a control of the companies. So PE firms gain control to drive improvements, uh, cutting down costs, selling assets to improve profitability. Tax shield, interest on debt is tax deductible. Okay, and exit potential through IPOs or strategic sales, they can post turnaround. So that's why leverage buyout is used. Risk of leverage buyouts is excessive debt load. If it is there, it can lead to cash flow problems or bankruptcy. And economic cycles, if downturns come in economic cycles, downturn is there, then it can magnify the financial distress. Operational pressure, cost cutting may impact long term competitiveness and a decline in asset value. If asset sales don't recover expected value, returns suffer. Okay, so those are the risks of leveraged buyout. Key metrics used in LBO analysis are IRR. So this measures funds annualized return over time, and debt to EBITDA, which is measures how much leverage is being used, and debt service coverage ratio, it assesses ability to pay debt from cash flows, and exit multiple of earnings before income tax depreciation or revenue at which firm plans to sell the company. So these are the metrics used: IRR, debt by EBITDA, and the debt service coverage ratio, and exit multiple. In India, this is less frequently used compared to the West due to regulatory and structural issues. Indian regulations limit use of excessive debt for acquisitions, but there are some deals which happen in India also through LBOs like Fortis Healthcare, SRL Diagnostics, and SL Group Asset Values have seen private equity driven restructuring. Okay. So the summary is basically this strategy of leverage buyout is used to acquire companies using debt, and the debt is repaid using the company's cash flows or assets. The pioneer in this strategy is KKR, which are featured in Barbarians with the Gate book and the RJR Nabisco deal. Successes are Hilton, HCA, and Dollar General. Failures are TXU, Toys R Us, and Caesars. Key metrics used are IRR, debt by EBITDA, cash flow, exit value, and the risk is high debt can lead to problems, uh, and economic downturns can magnify the pressure due to debt, and execution failures can also cause problems to leverage the buyout thing. Indian context, it is used cautiously due to RBI and SEBI restrictions. So that's the video for today. We have discussed about leveraged buyout and about KKR, and some of the successful examples and some failures. Thanks everyone for joining the call. Have a nice day. Bye.